Let's talk to Jane Foley, Head of Foreign Exchange Strategy at Rabobank. Jane, good to see you. UK Finance Minister Rachel Reeves being told to stop her imminent flight to China, stay at home in the UK, steady the ship. Her political opponents, of course, would say that, wouldn't they? But how serious is this?
Well, we do have signs that the gilt market and the sterling have settled down today in the European session, but there's no doubt that both assets, the gilts market and the UK sterling, do remain really quite vulnerable. And I think what we've been seeing in a very rapid way yesterday, but I think really over the last few weeks is a repricing of these assets towards a new reality really for the UK. So if we go back, for instance, to the first half of last year, growth for the UK in the first 2 quarters of last year was coming in much better than expected. There was optimism about the post-election government in the UK. We had the manifesto that was promising us from the Labour Party that we would see higher growth and that we would see more investment. And instead, actually, we saw a downward revision before the end of last year of Q3 GDP, which saw no growth in that quarter. So a much more pessimistic outlook has been forming really for the UK economy. Some commentators talking about stagnation, even stagflation. And it's against that background that the market realises that the budget, or the Chancellor's budget, has very little wiggle room, and that might mean more taxes, which could slow growth even more. So the market's adjusting really to a nastier reality for the UK than the one perhaps they had been hoping for, say, in the middle of last year.
The government insisting it will not borrow more to fund day-to-day spending. Really? Is that realistic? Are they going to be able to stick to that?
Well, there's certainly pressure for the government to really clarify this position. Now, I think one thing that is important for the credibility of the government is that it sticks to its own fiscal rules. However, if it does stick to those fiscal rules, well, that probably does mean a good chance that we'll either see more austerity being announced or more tax rises. Again, neither of those are going to do anything to help the growth outlook, which is already faltering. So there is no easy way out of this situation, and that's the reality that the asset prices are adjusting to right now.
Some economists, old people like me, are comparing what's happening now to 1976, when the pound fell so far. The UK had to get a bailout from the International Monetary Fund. Are we there yet, or is that still a long way away?
We're not there yet, but, you know, that doesn't mean to say that debt isn't an issue for the UK. I mean, it certainly is. The debt as a percentage of GDP in the UK is just below 100%. It's about 95.5%. Now, to give that some perspective, if we go back to the global financial crisis, just before the global financial crisis, it was around 50%, around that sort of mark. So we more or less doubled it in a relatively short space of time. Various reasons for that, of course, and many other countries in a similar boat post-COVID as well. So this isn't just a problem that the UK is finding. Now, we do have more credibility in the government. We do have a tighter labour market. There's lots to be said in terms of how far the UK economy has come relative to the 1970s. But that doesn't mean to say we don't have our problems. And certainly it does look likely that for many of us we'll be facing a pretty heavy tax burden in the next few years as the government hopefully makes structural reforms to put investment high up in the agenda and more growth and wealth and prosperity over the longer term.
Jane, thank you for that. Jane Foley, Head of Foreign Exchange Strategy at Rabobank.